Hi, welcome to On the Investor's Minds. I'm Tai Hui, the Chief Market Strategist for Asia Pacific at JP Morgan Asset Management. And thank you for giving us a few minutes of your time to understand what investors are thinking about right now and how that fits in with your portfolio construction. So in this episode, I'll be sharing 3 key topics that we've been discussing within my team over the last 2 weeks. We shall start with the Federal Reserve's policy outlook following the disappointing July non-farm payrolls number. Secondly, China's potential policy stimulus after July's Politburo meeting, and also India's investment outlook in light of the recent 50% tariffs from the Trump administration. Now let's start with the US Federal Reserve. Following the July non-farm payroll numbers and also the CPI data, the market is currently pricing in a 96% chance of a 25 basis point cut at the September meeting, with another 1 to 2 cuts expected before the end of the year. This was due to the weak July non-farm payroll numbers and also the significant downward revisions for May and June, indicating a weaker than expected job market. And these job numbers have provided the FOMC with the conditions to consider cutting rates. However, we still have the August job numbers and inflation numbers to consider. Fed Chair Jay Powell may also use the August Jackson Hole Central Bank Symposium to signal the FOMC's intention going forward. Now, for the July inflation numbers, the headline numbers did come in weaker than expected at 2.7% year over year, helped by stable food prices and also a decline in gasoline prices. However, core inflation rose to 3.1% in July from 3% in June. The impact from tariffs is not so obvious just yet, which could support the doves in the FOMC. In coming weeks, with more clarity on tariffs taking effect, companies may start to pass on some of these costs to consumers. Now, previously, I did argue that the Fed may want to hold rates until the fourth quarter of this year. However, the weak job numbers has changed that narrative to some extent, opening the door for the Fed to start cutting rates in September. The tariff-induced inflation argument may be also dismissed by officials, viewing it as only as a one-off. This is likely to keep a lid on US government bond yields and persuade investors to gradually increase duration in their bond allocations, as we suggested at the start of this quarter. Moving on to China, the mid-year Politburo meeting focused more on structural reforms than cyclical policies. A key announcement was that the 4th plenum will take place in October, and this is likely to set to unveil the 15th five-year plan, focusing on quality of development, innovation, and how to boost domestic demand for the longer term. Now, on the cyclical front, the Politburo maintains an easing stance on fiscal and monetary policy. Because of the better-than-expected economic data in recent months and also the current truce in a trade war with the US, the urgency for immediate policy support has decreased. However, challenges such as weak investment and the property market downturn means policy support remains vital for growth. Now, boosting domestic demand continues to be a priority, with calls for deeper consumption-boosting policies such as subsidies, and at the same time, despite strong export performance in the first half of the year, support for struggling exporters continues, focusing on optimizing export tax rebates and also promoting free trade zones. Exports may slow, but still contribute to economic growth in China in the months ahead. Now, the meeting also tried to address the anti-involution push, which essentially means managing excessive competition in many of the industries. But the reality is, without increase in final demand, the level of competition is still likely to put pressure on different parts of the supply chain. So in this sense, active management in picking the right sector, the right part of the supply chain, and the right companies are still absolutely essential. So overall, not a lot of short-term policies to boost growth, but certainly plenty to work with in the longer term in order to improve some of the structural challenges facing the Chinese economy from the latest Politburo meeting. And finally, let's discuss India. MSCI India has been an underperformer in 2025. At the start of the year, we were concerned about the elevated valuations and whether earnings could meet investors' expectations. More recently, the biggest news impacting India is obviously the 50% tariff that President Trump has imposed on Indian exports to the US. Now, to be clear, the macroeconomic impact of this tariff is likely to be modest on the broader Indian economy, despite the fact that it could hurt some of the export sectors, such as in garment and manufacturing. At the end of the day, India is more of an exporter of services rather than goods. India's exports to the US as a percentage of nominal GDP were only 2% in 2024, compared with 26% for Vietnam, 28% for Mexico, and 14% for Taiwan for comparison. And of course, the US and India could potentially reach a trade agreement to reduce headline tariffs. However, this episode could still challenge India's aspiration to develop its manufacturing industry for export purposes. We still see plenty of domestic demand for locally made manufactured goods, and of course, other markets demanding the same. Overall, we remain optimistic about the structural opportunities offered by India. We need more cyclical support for the broader economy and also corporate earnings expansion to justify these current valuations. And of course, active selection in picking the right companies that can feed into these domestic growth opportunities. So thanks for listening. If you enjoyed this podcast, please share this with your friends or colleagues. And of course, consider subscribing for more insights. If you have any topics you want us to cover, please reach out to your JP Morgan Asset Management client advisors. I'm Tai Hui. I'll see you in our next episode to discuss what's on the investors' minds. Until then, stay informed and stay invested.
This content is a general communication being provided for informational purposes only. It is educational in nature and not designed to be taken as advice or a recommendation for any specific investment product, strategy, plan, feature, or other purpose in any jurisdiction, nor is it a commitment from JP Morgan Asset Management or any of its subsidiaries to participate in any of the transactions mentioned herein. Any examples used are generic, hypothetical, and for illustration purposes only. This material does not contain sufficient information to support an investment decision, and it should not be relied upon by you in evaluating the merits of investing in any securities or products. In addition, users should make an independent assessment of the legal, regulatory, tax, credit, and accounting implications and determine, together with their own financial professional, if any investment mentioned herein is believed to be appropriate to their personal goals. Investors should ensure that they obtain all available relevant information before making any investment. Any forecasts, figures, opinions, or investment techniques and strategies set out are for information purposes only based on certain assumptions and current market conditions, and are subject to change without prior notice. All information presented herein is considered to be accurate at the time of production, but no warranty of accuracy is given and no liability in respect of any error or omission is accepted. It should be noted that investment involves risks. The value of investments and the income from them may fluctuate in accordance with market conditions and taxation agreements, and investors may not get back the full amount invested. Both past performance and yields are not reliable indicators of current and future results. JP Morgan Asset Management is the brand for the asset management business of JP Morgan Chase & Company and its affiliates worldwide.